really a lot of economic uncertainty. We asked investors, strategists, and our own CNBC contributors for their opinion in the Delivering Alpha Investor Survey. 61% of the 400 people polled say we have entered a new bull market. 39% say this is a bear market rally. 80% say there won't be a recession this year, maybe not at all. Let's bring in Jim Tierney, CIO, Concentrated U.S. Growth at AllianceBernstein. And joining me here, Ron Insana, CNBC senior analyst and commentator, co-CEO of Contrast Capital Partners. Gentlemen, great to see you. I can see you out of my peripheral vision, Ron. When I say the survey shows, no, there won't be a recession. Yes, there will be a bull run. Which of those statements do you disagree with when you're shaking your head?
When I'm shaking my head, it's the definition of a bull market, Contessa. I mean, in my learning over education over time, the last 39 years, a bull market really starts when you've taken out the old highs from the last bull market. So whether or not it's a bear market rally remains open to speculation. It has certainly been a tradable rally in the NASDAQ Composite, and the S&P 500. But NASDAQ, I should say the S&P topped out at about 4,800. So you'd have to go through that and stay above it on a consistent and persistent basis in order to define it as a new bull market. That's just my understanding of how you measure bull markets, not 20% off the
What about the recession question? Because in fact, with me, you have said before that there is likely to be a recession based on the data that we're getting from the economy, past performance.
Is no guarantee of future results. So I wrote a column today about we might be entering a Goldilocks phase and outlined some of the reasons why I might be wrong about the recession call, despite the fact that the yield curve is inverted, which since 1968 has a 100% accuracy rate in predicting future recession 6 to 15 months down the road, leading economic indicators down for over a year. Typically, all of that suggests recession. Manufacturing is contracting, real estate's in recession, but we've got three things that would suggest that maybe that recession call can be put off. And that is, number one, households are not as interest rate sensitive, nor are corporations, as they were in prior cycles. They all locked in long-term mortgages or long-term debt. Yeah. You've had a manufacturing, I should say, construction boom in manufacturing and residential real estate. And then you've had some other factors that have maybe offset more of the Fed's tightening than we would have otherwise thought, which is fiscal spending, which is stimulative, not contracted.
Jim, when we're looking at how far the tech rally has gone this year, AI gets a lot of the credit here. Do you think that there is still enough enthusiasm over AI to keep fueling growth for the second half of the year?
I think when you look at the market performance, up 17% this year on estimate cuts since the beginning of the year, you have about a 20% PE expansion. I think that's going to be very difficult to duplicate in the second half of this year. Getting to AI specifically, I think we have to see benefit for all companies. That will come. I'm just not sure that's going to happen in the second half of this year. And the fundamentals get tougher. And you looked at consumer spending today, the consumer's pulling back. So all of that suggests that the fundamentals are more stretched here than not.
We were just showing your picks that you said Abbott Laboratories, Automatic Data, and American Tower are stock picks that you think can weather whatever's to come in the second half. Where are you seeing these cracks? I mean, you were talking a little bit about consumer spending here. Do you think that those gaps will widen for the broader economy?
I think they have to. When you look at the totality of what the Fed has done over the past 18 months or so, 500 basis points of hikes and maybe a couple more to go, that will eventually have an impact. You look at existing home sales down 20% year over year. That's because people just can't move out of their house. They can't give up that 3% mortgage and take on a 6 or 7% mortgage. So I think there are things that have delayed the recession, and they may continue for a few more quarters. But ultimately, we probably get into a recession here.